Okay, this teaching is going to be quite an important teaching, yeah? It's going to be something called the data ranges. One thing everyone cares about is where does price trade to? Oh, it's trading to an order block, it's trading to an imbalance, it's trading above a high, it's trading around this area. What the 90% don't do is they don't consider the time aspect. There are two axes to this chart. Price is one of them. It's important because it's an axis. What's the other one? It's the time. The date, the time. Yeah? When there is a market structure shift, what does that mean? Let's talk about that. What does it mean? People just think, oh yeah, now we're bullish, now we're bearish. I don't want you lot to have that mindset of we are now bullish, we are now bearish on the daily. Yeah? I don't want you lot to have that. When you feel the need to say, I'm now bullish or we're now bearish, I want you to say there has been a change in the state of delivery. The algorithm is now seeking sell side liquidity. Or on the other hand, there has been a change in the state of delivery and the algorithm is now dictating higher prices to take up buy side liquidity. That is what causes the bullish and bearishness. It's not buying pressure, selling pressure, whatever. It's the algorithm deciding what it's trying to attack. Just take off all of these. Let's just take all of them off. Yeah. So an algorithm, right? It needs reference to time. Yeah, it needs to know where the highs are, but what highs? Is it these highs, these highs, these highs? Is it these highs? What highs are we talking about? What highs are we talking about? That's where the reference to time comes in place. You need a reference to time. You know, you hear the uneducated or the misguided traders, and they say that the banks and the big players, they know where your stop losses are. They can see them. They can't see them. They cannot see them. You cannot see where someone else's stop losses are, but the algorithm looks to trade into specific areas within a certain time frame or time lapse where it is common for traders to keep their stops. When you learn how to trade, where do you put your stop losses? Below lows. If you're buying, you put it below the lows, right? If you're selling, you go put it above the highs. And the algorithm will eat that in the long run. It would chew it up. So when there's this change in market structure shift, the algorithm needs to have a certain look back period in order to attack liquidity. Because otherwise, it will just keep attacking liquidity back into 1995. It needs a reference to time. When there is a market structure shift, so for example, we'll trade in heavy up here, yeah, we'll trade in heavy up here, and then we see that we trade below these lows. Now we trade below these lows. What do we expect? And there is always a change. A change in market structure happens very often. It's not every 3-4 months. Like I said on the quarterly shift video, last lesson. The last lesson is more of a long-term thing, 3-4 months. Yeah. This is whenever there is a change in the state of delivery. High, significant lows. Yeah. When we take out this high, this low, that's a change in market structure. That is a change in market structure. Yeah, that is a market structure shift. Now, when the algorithm takes that out, what does that mean? No, we're not bearish. We are now anticipating the algorithm to attack sell stops. Therefore, sell side liquidity will be taken out and will deliver lower prices. That's what the algorithm is doing because look, it ran these highs, it ran these highs. It came up, closed this little volume imbalance within here, and now it's saying what? Okay, buy side objectives are done. Let me go clear out some sell side objectives. What sell side objectives though? This is where it comes in handy. Yeah? Market structure shift happened at here. What day did it happen on? This day. The 19th of April is when it happened. When you code an algorithm, you want to code specific languages within to it. Does it make sense for the algorithm to just look back at a random day? No. It works on, the referencing to time works on calendar days. And what's the nicest date to code into an algorithm? The first. The first day, right? The market structure shift happened in April 19th. So we go back to the first calendar day of the April. This is the day that the algorithm would use to do its look back period. Now I'm going to introduce you to the data range look back period. Where does the algorithm know to deliver stops? Where will it on the right hand side of this set? So now you have the look back, you have the past and the future. You need this to happen. We need this to happen. We don't know it's a market structure shift until this happens. When this happens, vertical line goes on the first calendar day of the market structure shift, the 1st of April. Now the algorithm would do what? It will look to specific data ranges. It will use specific data ranges to dictate where price will be delivered to. Let's do the first one. The first one is 20 days. 20 days is the first one. The second one, guys, is 40 days. And the last one that it will consider is 60 days. I know this looks confusing. Just bear with me. Where does the algorithm look? It needs a reference to time. It's got the reference to price. It has reference to price, but it needs a reference of time where it would go on the short term to collect sell side liquidity. Within 20 days, there's this low. Within 40 days, we have this significant low. Yeah? 60 days, we have these lows, but the significant low was made within the 40 days. This low was the most lowest low. Yeah? Outside of this, there wasn't anything because this is outside of our range. So what does the algorithm do? Now these lows are the reference points. This is our reference to time. These are the places that the algorithm will look to trade to when there is a bearish market structure shift. These are the lows that will be attacked. This one got attacked within the market structure shift. This low is within what? 40 days, as well as this low. And what happened? Taken out. Taken out. Now, look at this low. Why didn't this low get taken out? Because it's not in the 60-day reference point for the algorithm. The algorithm doesn't have a brain of its own. It doesn't think, well, I took this low out, let me go take out this low. No, it does what it is told to do. It's coded. When you code something, it's done. It's written. It can't then go and have a mind of its own. It doesn't even know this one exists as of now. Yeah? As of now, it doesn't consider this. Doesn't consider that low. It considers only within the 60-day look back period. This is the most significant low, so it trades to that. This is so important for you guys with your buys because once this low goes out, people think, oh, it took out this low. Order block, order block. Those order blocks are going to get traded through. Why? Because we are now in a sell side delivery state. That is what's going on. Market structure shift. We look back 20, 40, 60. We know we'll have the highest probability where price will trade to. Your eye should go to the lows, this low to get traded through. Done. Next one, we want to see this low get traded to. Yeah? So when you have that low getting traded to, remember, it's not just going to trade one go. It will do what the market does. It will go up, it will go down. Yeah, it will rebalance imbalances and things like that. It will take out short-term highs and then fund a bigger move downside, just like I went over in the last video. When the market structure shift happens, it takes out the 20-day. We retrace into, this is an imbalance. From this wick, yeah, from this wick to this candle's wick, yeah, there's imbalance between this area. Trades up into it, breaks down lower, takes out this high, this low that was made within the 40 days. Then we trade again higher. We take out these relative equal highs. You see this candle right here? It trades just above all of the rest, yeah? So let's look at this candle's high, yeah? Look here on the H. 91,428, 91,436. It just sweeps it. The algorithm just sweeps that high. And then it breaks down lower, comes up to rebalance this area, and it breaks down lower, completing our objective. Now, the same way we done that, let's do the 20 days forward. You lot should see the pattern already, but if not, of course, I'm gonna shed some light on it. Now let's look what happened 20, 40, 60 days ahead. The algorithm is looking to take out the reference points to the left until there's another market structure shift. Whenever there's a market structure shift, you do this, yeah? Because then there's another market structure shift here when it takes out this high, yeah? And we'll do it again for this one, yeah? 20 days, what happens within 20 days? Within 20 days, there's a low made. Within 40 days, it hits the 40-day range, hits this low on the head. Yeah, let me delete this line. Yeah, this low, yeah, look, 40 days. It nails this low exactly. 60 days, we make the low that takes it out. Now you have your reference points. Now this can all happen. All of this can get smoked within 20 days. The cast forward is not as important as the cast back. The cast back gives you your reference points to the lows in the past within a certain data range to get taken out. Yeah, this is the low that we want to get taken out. Within 60 days, we want to see this low get taken out. So if it hasn't happened within 40 days, it will happen between 40 to 60 days. It will get taken out. Yeah. This is how you build your bias. With the market structure shift now, you know there's a market structure shift. So you know to get bearish. That's what the previous video was touching on. Yeah? Market structure shift, how to identify and what to expect. Market structure shift just means there has now been a change in the algorithm state of delivery. It has gone from delivering buy side to sell side liquidity now because we're seeking lower prices. But which lows are going to get taken out, Omar? This is where you do the cast back. So you find the 19th of April, that's when the market structure shift happened. You go to the first calendar day of that month. 20, 40, 60. Look at the lows within that. There's a low here within 20. Within the 40 days, there's this low and this low. Within 60, there's nothing lower than the 40. So let's just consider the 40. Now, we want to see Within this market structure shift to the downside, we want to see price trade to these reference points within time, the 40-day low, the 20-day low, the 60-day low. As well as that, it's not always just the lows. If there's imbalance that needs to be rebalanced, it will do that. Yeah. If there is order blocks that need to be filled, it will do that. It's not just liquidity that it seeks. Remember, we also rebalance imbalances. So let's get rid of these drawings. And now remember, there's another market structure shift that happens. Yeah, there's quarterly shifts. Yeah, don't get it twisted with the quarterly shifts and the market structure shifts. Within a quarter, there could be a few market structure shifts, but in the quarter, there's usually just one big trend that happens. Now we break this high. When we go above here, we broke this high, right? But there's imbalance here. So let's say this is the market structure shift. This one, yeah, 5th of May. When we break above these highs, there's been a change in the state of delivery again in the algorithm from sell side to buy side. Now we're attacking buy stops. So what do? We look for what? The day that the market structure shift happened, which is this day, the 17th of June. So then we go to the first calendar day. Why the first calendar day? Because the algorithm needs a benchmark to look back. It's not going to look back at the 17th. When you code it, you're not going to code in the day that the market structure shift happens. No, it's not going to happen. It's not like that. You code something that is easy for the algorithm to recognize. When that happens, go to the first calendar day. When the first calendar day is nice, it's easy, it's the first day of the month. Then you look back. So let's do the look back. So this one, let's get the trend line. Let's go with this. 20. That's our 40. That's our 60. So what do we have within 20 days? The market structure shift happened, yeah? 40 days, what do we have? We have this high. Within the 60 days, we have what? Imbalance. We have these highs above here. Yeah. Most importantly, what do we have within 60 days? A volume imbalance. We have a volume imbalance that the algorithm would need to deliver to within the 60-day time frame. Yeah. Now let's cast forward the 20 days and the 40 days and 60 days. You can see exactly what I mean. Within the 60 days, what happens? Within the 60 days, we see this volume imbalance get cleared up. This is also a rejection block. Yeah, we'll be going over that in a few weeks. But look how the algorithm uses data ranges in the past to dictate where price wants to deliver to. You always need a reference to time because otherwise you think that this high is going to get taken out. You think that, oh no, it's going to go lower from here. It's going to go from here. We're going to go lower. We're going to go lower. But why? Within the 60 days, we still have more targets within the 60 days to complete. So we go and complete that. Once the 60 days targets are completed, it could go and seek the liquidity above here. Of course, it can do that. But these are your checklists that as a trader you need to have. Volume imbalance within 60 days. Within 60 days, yeah, there's this imbalance and there's highs and liquidity. So you're expecting all of this to get traded through. when the market structure shift happens, you are expecting that to get traded through. Do you get what I'm saying? It's so pinnacle, you have a reference to time. Now, reference to time, the reference to time yearly is the quarterly shifts. The reference to time that we're having when there's just a market structure shift is the 20, 40, 60-day lookbacks. There's also references to times when it comes to an intraday level, a daily. When you're day trading, there's also reference to times there. However, we are going to blend everything together because now when we have this, what's our bias? Market structure shift. Until we finish the 60 days, what are we looking to do? We're always looking for long entries. Not every day is long. Not every day is long. Listen, there's a clear distinction between looking for long entries and being long every day. Long entry doesn't always happen every day. Listen to that again. A long entry does not come every single day when you're bullish. When you're here. There was no need. There's no bullish. There's no long setup. We're clearing this imbalance in this area. We're finding rejection from this area. The imbalance is being respected. Remember, bullish bias. We want to see bullish imbalances be respected, bullish order blocks be respected. Yeah, we want to see lows getting respected, and we want to see the opposite we want to see the opposite being traded through. So now this is within your 60 days, because there's still all this to trade through within the 60 days. This is your long entry, and it's good long entry. Why? Market structure shift. Within the 60-day look back, you have this high to trade to, you have this imbalance to trade to as well. So using the 60-day look back, now you have your long entry at the imbalance. Intraday level, you just go and you get long. Yeah? Until the next long entry happens. When you find your next long entry, you enter long. Until the 60 days is completed, then sit on your hands. Yeah? Unless there's a clear setup, sit on your hands. Yeah? Like this low got respected. Remember, from this low to this high, this is an intermediate. We don't care about that. We care about the external liquidity. Remember that. Yeah? And as of now, we want to see where the DXY trades to. Now, what's happened on the DXY currently? What has happened? This high has been taken out, but we are heavily rejecting off of it. Seem to that we can't close above it. Price comes down. When price breaks the low, we do the 20, 40, 60-day look back, and we have our targets. When it breaks below significant lows, yeah. So once it breaks below, for example, this low, expect this low to get broken, because I can see just without doing the look back period that from this low to this low is within 60 days. So you'd want that one to get traded through. This is so important. You always need a reference to time when you're trading. Nothing is ambiguous in this market. Everything happens on time. Everything happens when there's a change in the state of delivery. The last previous 60 days, those liquidity pockets, they will get traded through. Because going back to here, when the market trades down, yeah, what does it leave? When the market trades downwards, where is the liquidity now? It's above the market. When the market trades down, the liquidity is above the market. Simple, right? Because when you're trading lower, you're taking out the sell stops and what's getting respected the highs. So there's liquidity that's built up above these highs. So when there's a market structure shift, the algorithm looks to do what? Seek liquidity. But seek liquidity where? Within the 60 days. That's what we're doing. We're having now a reference to time. Within the 60 days, let's hit the liquidity pockets as well as the areas that need rebalancing. For example, this area needed rebalancing and this area needed rebalancing. So we deliver liquidity within 60 days and we rebalance areas within 60 days. Until the next market structure shift happens, that's what you keep doing. Yeah? If there's no market structure shift, then you're always going to be bullish until there's a bearish market structure shift. There's no reason to not be. That's overall. Of course, within this bullish trend, there's a lot of dips and retracements. but they're easy to know where to go to. Like this order block was in the market, yeah? Price went up higher. Well, if there's going to be a level of retracement from here, where is the logical place for retracement to happen? Areas of rebalance or order blocks. This order block to the 50% of the order block got tested, and that retracement finished, and we seeked higher prices. I want you not to start thinking like an algorithm, and it might sound crazy to you guys, but that's how your success in trading will come. It will come from understanding how the algorithm works. Now, why the 50% and the opening? Well, if you're going to code an algorithm and you need specific reference points when you're coding an algorithm. Like when you code an algorithm to do something specific, you need very specific code. The more complicated the code gets, the more crazy that your algorithm will become. You want something simple. So with reference points to price, yeah, let's talk about price. Reference to points to price. Trade to the opening price of this. Trade to the midway price of this. Is there a reason for you logically to code it as trade to the, I don't know, the 68th percentile of this order block or the gap? No, you want to use nice reference points because it's easier to do it like that. Opening 50% are such common computations in coding. They're very common when it hits to 20%, 50%. For example, yeah, let's consider a machine that's coded. When the machine is working too hard and it's going to overheat, you want a reference point for whatever code runs the machine to automatically turn off. What reference points are you going to do? Oh, yeah, when it just gets too hot, turn it off. No, you need to be specific with the code. When the machine reaches 50 degrees, or when the machine reaches half of its functioning temperature, cool it down. That's how you code things, people. That is how you code things within this market. 50% and the opening are very key for price. Those are references to price. The opening and the 50%. Those are your references to price. Now you got your references to times, the 20, the 40, the 60-day lookbacks. So what do you want to see? You want to see price when it retraces to the 50 or the opening of an imbalance or order block, or we're going to go into other things as well. And then you want to see it or you want to see it continue the move into the reference points in time to trade to. There's a lot that was said in this video, yeah? And also, so you guys are my mentorship group, right? And I'm going to keep it 100 with you guys because you guys are paying me money. You don't want to be paying money to a guy that can't trade and that can't make returns. So I'm going to show you my account analyzer. This is my account analyzer. It's a lot of money. Alhamdulillah, I made a lot of money. And I hope you lot, I seek refuge from the evil eye if you lot believe in those things, which I do. This is no way for me to, stunt on people. But what I wanted to show people is 15% in 2 days. This is the 2 days. This is my certificate if you lot don't believe me. Yeah. Anyway, it says live here, so you know it's live. So today I lost money. This was actually 20% actually, and I lost money today because I took a silly trade. That happens. That happened with me. What happened was I made 20%. I didn't even aim to make 20%. I wanted to make 10% a month. So now I have a whole 10% to play around with extra. So I was like, you know what? Let me just see if I can run it to like 40%. So I risked a bit extra on the trade, and I lost the trade. That stuff happens. If I won that trade, I would be laughing my ass off. But those things happen, and I'm gonna keep it real with you guys. You can see minus 3.79%, but I'm still 15% up. Look at the average return per trade, 1,300. What's 1% of a 100k account? 1%. Go for the 1-to-1s and the 1-to-2s. You lot can see my win rate. You lot can see the 15.6. Yeah. Now let's say the trade history. This is the trade in history. So I took 3 losses today. I won 1, 2, 3. So I won 1, There should be more trades here. Yeah, look. So you see the average is always a 1 to 2. So that's break even trader scored at 1 to 2, 1 to 1.7. This was a runner that I had. Yeah, these two I remember they were just runners that I left on 1 to 2, 1 to 2, 1 to 3. I don't go for crazy R's. I don't do that. Do you know why? I can get in and out quickly. My philosophy in the market is velocity is your best friend. Velocity is your best friend in the term of it is going to compound your account the fastest. When you're trading and you want to hit the crazy R's, how long would it take for you to hit the crazy R's? It will take you. A 1 to 5 does not happen quick. That's one thing I'll tell you guys. Yeah, the 1 to 5s don't happen quick. Yeah, but the 1 to 2s they happen quickly and they are very nice on you psychologically. They're very rewarding because they hit take profit fairly quickly. If you go for 1 to 5, a lot of times you're letting on a trade go on to the next day, and within the next day there's always a retracement into the opposite direction of your take profit. Do you want to sweat through every single trade? Do you want to sit there and watch your profits get eaten and potentially reverse on you? Because the longer you're in the market, there could be a market structure shift on your ass. Then what? Your stop's gonna get taken out, whether you like it or not. Whether you, as much as you pray that doesn't happen, as much as you do anything, it will get taken out. I advise you lot two things. Go for a 1 to 1 if you're gonna trade. 10 pips for 10 pips. Just go 10 pips for 10 pips and see how it is. Yeah. But what I want you lot to do is focus now on getting the daily bias correct. You lot have the tools to get the daily bias correct. Going back to the DXY, you have the market structure shift. When you've seen a market structure shift, what do you expect? You're expecting you're expecting higher prices. Yeah. So then there should be a shift in your bias. We've taken this high. We've taken this liquidity out of this high. Yeah. There's imbalance down here that the market will look to rebalance. If you go on the 4 hour, if you go on the 4 hour, you see that there's this order block and there's also this level of imbalance. So you want to see this get filled. So you can be bearish until you feel this. Then you want to see how price is treating this. Is this becoming respected? Is this order block being respected? If not, you continue being bearish until you trade through the lows. And then there's this imbalance. This is how you get your bias. You want to look for what is price respecting and what is price rejecting. Is it rejecting bullish objectives or bearish objectives? Right now, we slapped this high out, this high slapped this high out, and it looks like we're coming down lower. So your daily bias for tomorrow, based off this rejection, could be what? We're breaking down below these lows. So there's equal lows right here. When we see equal lows, what do you expect to happen? Lows, equal lows, they don't remain in the market for too long, do they? There's this imbalance that we want to see get filled in. These are things that you use to piece your bias together. And it all starts from the daily. Because we want to see what is the opportunity, what not the opportunity, what is the chances of the next daily candle coming down? Just from the look of this one, just looking from what's happened, what is the chances of this candle coming down? The next one. Is it more likely that it's going to go down or up the next day? Based off of having a logical educated guess. Is there imbalances to fill down there? Is it taking liquidity from up now wants to deliver it to the bottom? If you're sure that it should be bearish, then the next day you look for a bearish opportunity. That's how you get your bias day to day. Yeah. So any questions? Hit me up. This is the what we went over now, the 20, 40, 60. I want you lot to find market structure shifts and do the 20, 40, 60 look back. Now you might have some hard times identifying market structure shifts. The 20, 40, 60 day look back period would not be beneficial if you cannot identify market structure shifts. So study identifying market structure shifts first. Once you're getting good at that, then apply the 20, 40, 60 day look back and the 20, 40, 60 day cast forward and see how price has delivered to those 60-day look back period. Any questions, just ask me on the discussion. If you want, we can hold a Zoom for this one. Whatever you guys want, you just need to communicate what you want, sir, and I'll try provide it. Yeah? Till next time, take care of yourselves.